Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Oil jumps higher after a report that Israel is possibly preparing for a strike on Iranian nuclear facilities, raising concerns about the fate of US-Iran talks. Traders ramp up bets on a surge in long-term Treasury yields with a focus on the 10-year testing 5% as concerns rise about President Trump's tax bill. Plus, G7 finance chiefs discuss tariffs on low-priced Chinese products. The group meets in Canada with members taking steps to avoid conflict with Washington.
In the meantime, a quick check on these markets. Risk sentiment pointing to the downside this morning. Futures down about 0.1%, but we're seeing a little bit of underperformance in the FTSE 100. Not massive moves relative to what we're seeing in the U.S. That's really where the sell-off is intensifying. So keep an eye on that futures picture. One eye, of course, on the strength that we're seeing in the Japanese yen as well. 143.62 on dollar yen. Some of that is a bond market story. Some of that is a deficit story. Some of that has to do with the BOJ. We'll dive into the details. And, of course, Brent crude, as Anna was mentioning, off the headlines and reports in terms of those Middle East tensions. 66 handle on that commodity, higher by 1.4%. The countdown to the opening trade starts right now.
So Hugh Pill, the chief economist over at the Bank of England, was warning yesterday that maybe quarterly cuts on interest rates might be a little bit too much for the Bank of England, given the fact that inflation is proving to be a little bit stubborn than anticipated. We get data to support his argument in the last couple of seconds. CPI month-on-month 1.2, up from prior 0.3, well above expectations. We now have a headline number year-on-year of 3.5. That's up from 2.6. I would also point you in the direction of what is happening with gas prices right now, but the core number is at 3.8 on core, and the services number pops sharply higher to 5.4%. The bond markets, the foreign exchange story, front and centre right now.
Yeah, absolutely. We were expecting this to go higher, but not by this much. And a lot of that was to do with regulated energy prices, which are fairly easy to predict. So that's kind of in the mix there. So we had expected a bit of a pop higher, but it's that services number, I think, that is much higher than expected, 5.4% against an estimate of 4.8. And that's where they had been concerned in the Bank of England around that. And partly that is what is driving expectations that inflation goes higher still into the autumn, into the fall this year. And so we might not be done with worrying about inflation.
What is interesting is that the pound initially spikes on this, but is now falling, which is interesting. So we are now lower than where we were going into the number, which I think is quite interesting in terms of the dollar rate. So we're 134.30 now. So it's interesting that we're not getting a bigger reaction in the pound. 134.34 is where we are trading at the moment. We are up on the session, but we're not up on the data, which I think is quite interesting. You can't really see much of a movement there, which is quite interesting in itself. Not much of a shock in the market, despite the fact that actually, at a headline level, these numbers look quite shocking.
Yes, and from an FX perspective, more broadly, I suppose, we're dealing with quite a lot of dollar weakness. That seems to be the story. And that takes us a little onto the next agenda item, actually, that we were going to talk about, which is about oil prices higher, moves into havens, and the yen is higher on that, but the dollar is not. And I think that's notable, the way that we've got this story around the potential for Israel to strike at Iranian infrastructure, and yet the dollar doesn't go higher. We see the yen go higher, gold goes higher, oil goes higher, and the rest. But the dollar really responds in a very different way.
Not a safe haven.
Not a safe haven seems to be the way that the market is interpreting this, Kriti.
Absolutely. We're looking at Brent crude, which I think is interesting. It's only higher by 1.3% to your point. A geopolitical risk premium baked into oil is technically usually about 3 or 4%. So that should put into context that oil is reacting, but perhaps not freaking out or panicking off this report, because the details around the report are still a little hazy. And this is also just an idea that CNN has reported that Israel is considering non-actual move or a decision.
This is a report on a U.S. intelligence report on a report coming out of Israel. So there's a number of different stages involved in this process to get us to the point at which CNN is reporting.
And what is the market reacting to? Well, maybe it's the thoughts of what would happen to the Iran-US talks, as we said in our headline, but maybe it's also the reaction function in Iran. If there were to be this kind of action, what would that do to shipping routes in the region? And that's what sends the oil price a little bit higher than this morning.
There's always that nervousness surrounding the Straits of Hormuz. The story this morning, actually, I think, is oil to a certain extent, but I think oil is in many ways a derivative product product of what we're seeing in a wider market, which is worrying about what is happening with the bond story. US 30-year, pay attention to where we are. We are back above 5% this morning. Japan is worth paying attention to as well. You've got a big move higher, though it has faded in terms of yields that we're getting out of Japan. Apparently, the Japanese Prime Minister was in Parliament yesterday talking about the fact that actually Japan is Greece-like. I struggle with that comparison in terms of kind of where we are with the Japanese story. Doesn't have the same sort of problems that Greece had going into the financial crisis. But nevertheless, you are seeing concern around the long end. This takes us back to what is happening with US politics, the BBB, the Big Beautiful Bill, what happens to that going forward from here, whether or not actually we see President Trump being able to get this over the line. There's all kinds of concerns around what will happen in terms of SALT deductions and what happens with Medicaid, and ultimately do we end up with a bill that produces a higher deficit going forward? That seems to be the tone at the moment. But certainly the long end is sending a pretty clear warning as to what is happening in the United States. Fold in the inflation story as well. It's a pretty ugly picture.
We went over 5% at that very long end, didn't we, 30-year on Monday, and that was a bit to do with Moody's, but that didn't last for long. But there is that nervousness there. Well, we're really close to that level right now, once again. And there's a real focus on 5%, Kriti, at the 10-year. And you look at option skews, and they seem to be suggesting that a lot of people are betting on us getting there.
It's fascinating because if you look at a longer-term chart, and I did this morning, of when was the last time we hit that 5% level on the 10-year, it was in 2022, and before that, 2006. So this is not a normal a level to hit, but it's also, I think, the margin of the move that freaks everybody out here. Simply this idea that in 2022, when we had hit that level, it was coming off of this massive surge. It was Fed hikes that was really moving it, that a lot of corporates had to kind of digest very quickly. This has been a gradual story. We've been in the range of kind of 4 to 5, 4 to 450, really, for the last year or so. So a 5%, getting to 5% isn't as scary of a prospect as potentially it was with that bigger margin a couple years ago.
I think a 10-year at 5% would be a pretty scary prospect.
If you see a faster move.
Yeah, I think just those kinds of levels start to obviously have an impact in terms of the way you discount the equity story. That would be a significant headwind, you would argue, for the equity story. 5% yields on a US 10-year. You've also got, just back to the dollar, I think it's fascinating that the euro was bid this morning. You've got the yen being bid this morning. You've got the Swiss franc being bid this morning. There are alternative safe havens. And it's interesting, Morgan Stanley's out with a note talking about the fact that you actually do want to buy America. You do want to buy American bonds. You do want to buy American equities. But you probably want to hedge the currency.
Yes.
Which kind of, I think, is an interesting sort of aside.
And back to where we started, the pound also bid, but really not sure what to do with that inflation data, and that has settled down pretty much unchanged as to where it was when we started that conversation around UK inflation. Kriti, which takes us on to global finance and the G7. Lots of really interesting thoughts about what might come out of the G7 in Canada. A lack of conflict with the United States seems to be everybody else's aim going into this G7.
Absolutely. Really skirting some of the key issues that I think have been key parts of the trade deal, first with the EU, with the UK, and, of course, with China as well. But here's one place where they're united, where a lot, Canada and members of the EU as well, are looking at increasing perhaps some of the tariffs or imposing a teeny tax. I'm going to call it teeny because I think it's a fair one, but it's €2.
Because the parcels are teeny.
Yes.
Individually, but cumulatively?
This is true. But a good chunk of it is going to the states anyway. So it made sense that this is falling on the de minimis rule. What is new here is that the EU is basically following suit on that similar thing, which is where that €2 kind of, again, teeny tax, I'm branding it, is important here. But it's also showing that they are aligned on the tough in China stance, but not angering the United States.
Right, they don't want to anger they want to be aligned with the US on being tough on China. They don't want to anger China too much, though. But I'm fascinated that the United States has opened up this conversation that allows for other countries to take action on these small parcels and the tax and what that does to their retail sector. Because prior to what the US has done and the change in the narrative, perhaps this would have been cast as, OK, you're putting up prices for consumers. Tell us what's the good story there.
Retailers here in the UK have been pushing for this for a long time. This is something that has been an issue for them for really quite a while. The UK, I think, is open an investigation. The Europeans feel a little bit further on than the UK does. The US obviously feels a long way on from where anybody else is. Yeah,
I'm also really interested to see if there's any movement on the Russian oil price cap, which the G7 put in place back in 2022. It's at $60, which in 2022 was quite low, but it's not that low anymore versus where we are on global oil prices. But after that Trump-Putin conversation just what was it, yesterday, day before, you wonder whether any agreement has been made there. And that seems to be unclear as to what commitment we have on that front.
OK, let's talk about what we've got coming up on the show. In a moment, we're going to be talking fixed income and the foreign exchange story with Lindsay Rosner, Goldman Sachs Asset Management. Rob Arnott's going to be joining us from Research Affiliates. He's got some interesting views on exactly what government spending does to growth. We'll talk about that. Steve Chiavarone, Federated Hermes, is going to be joining us a little bit later. And Francine is going to be in conversation with Amanda Staveley, PCP Capital Partners. That conversation coming out of Doha a little bit later, Chrissy.
Absolutely, and plenty of data as well to keep our eye on, and some earnings. If we're worried about that U.S. exceptionalism story, do we see the same warnings out of Walmart and Home Depot into some of the earnings that we are going to get stateside as well? Before the bell, Target and Lowe's are going to be reporting at 9 a.m. UK time. Before we even hit those earnings, we are going to get the ECB Economic Stability Review, so one eye on that as well. And then plenty of Fed speak over in the States. We've got the Richmond Fed president and Michelle Bowman, of course, the hawk of the committee, but also someone who's been talking about loosening some of the regulations, which has been met with mixed results and mixed reception over in the States. And, of course, if we are worried about the sell-off in the long end, we've seen it spill over into the 20-year over in Japan. Does it spill over into the 20-year in the U.S. as well? That auction at later today.
Yeah, so from Japan to the United States, a bit of worry about the long end of bond markets. Away from the market conversation, then, let's turn to corporate news. Elon Musk says he's committed to leading Tesla for the next 5 years and plans to dial back his financial involvement in politics. He spoke in a wide-ranging interview at the Qatar Economic Forum to Bloomberg in Doha.
I think in terms of political spending, I'm going to do a lot less in the future.
And why is that?
I think I've done enough.
Bloomberg's Michelle Hussain, who was in conversation with Elon Musk at that event, joins us now. Michelle, give us a sense of some of the standout moments in that conversation for you with the Tesla CEO. He gave you some fairly short, brief answers in some places.
In some places, yes. Anna, good morning. I think that this interview was a combination of coming out with some very specific information and, for example, on political spending, as you said, but also on his companies, that he's going to remain as Tesla CEO for the next 5 years, that Starlink may have a public listing at some point, that SpaceX won't be moving into the weapons business, despite Elon Musk saying it had many requests to do so. So there was that kind of news, and then there were also personal elements. He clearly has been upset, and he expressed that about the attacks on Tesla cars and Tesla dealerships in recent months, and he also became very exercised when we talked about South Africa and black ownership laws, even though, as things stand, and Bloomberg reported this story yesterday, it looks like the South African government may be ready to offer him a workaround to those laws in order to get Starlink into South Africa, and on the cusp of a White House meeting for President Ramaphosa with the president in the White House.
Michelle, good morning. It's Guy. You had a really interesting exchange with him on Tesla, and he suggested that the company was already turning around, but he also suggested that he was going to spend more time focusing on it. What was your takeaway from it? What was his kind of... Did you get a sense from him that there is a crisis at Tesla, that he has got more work to do, that things need to happen and happen fairly quickly?
So, Guy, he was definitely keen to characterize what others might see as a serious crisis at Tesla, not just in Europe. That was the market that he was willing to acknowledge in terms of declining sales. But it's also the case that if you look at the picture in China, and our colleagues who write the Hyperdrive newsletter have the detail on this, it's out today. But the fact is that Tesla has been shipping fewer cars out of its China plants in recent months, and that has been a persistent trend. So there is work to do. I think his answer to that is himself. I'm here, I'm back, I'm going to be the chief executive for the next 5 years. My pay, he said, is a factor, but control of the company is more important. So he's betting on the fact that the same energy and vision and leadership that did enable Tesla to change the car industry is going to be the thing that brings it back from the picture in some parts of the world that we see today.
Michelle, thank you very much. Bloomberg's Michelle Hussein joining us there with a recap of that conversation she had with Elon Musk at the Qatar Economic Forum. And speaking of QEF, later today we will be speaking with Donald Trump Jr., so that will be part of our conversation. Lots of other conversations coming to us from Doha as well, Guy.
What else do you need to know this Wednesday morning? The UK has announced a series of measures to punish Israel over its actions in Gaza, including a pause to free trade negotiations and possible sanctions. The EU's top diplomat has also urged Israel to unblock aid to Gaza. Speaking to the BBC, the UN warned that 14,000 babies in Gaza are at risk of dying within a week if more aid does not enter the territory. Builder AI, a British artificial intelligence startup backed by Microsoft, is filing for bankruptcy after the company's chief executive said major creditors have seized most of the company's cash. He told Bloomberg that Veolia Credit, which provided $50 million in debt to the software firm last year, has seized $37 million from the company's accounts, leaving it unable to pay its bills. Veolia has been approached for comment. We have yet to receive that. Julius Baer says it's booking another large loss from property developments that it helped finance. The bank has disclosed a loan loss charge of $156 million related to its private debt business and selected positions in its mortgage operations. It comes as the Swiss lender attempts to emerge from a crisis triggered by exposure to Renibenko's Signa real estate empire.
Coming up on the programme, a luxury downturn hits Chanel's sales. We will check on the luxury sector at the market open. Plus, gold rises for a third day as geopolitical tensions persist, boosting haven trading. Up next, Donald Trump's tax bill prompts traders to ramp up bets on higher, longer end yields. We will get a perspective from the credit markets. If you have any questions, you want to get in touch with us, the team that puts together this programme, ID plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
This week, Bloomberg brings you live coverage from the Qatar Economic Forum. Bloomberg Horizons Middle East and Africa and The Pulse will be broadcasting live from the conference floor. Then, throughout the day, we'll bring you all the highlights from the key policymakers and market movers on the issues confronting the global economy. Live coverage from the 5th edition of the Qatar Economic Forum continues this week right here on Bloomberg Television. Context changes everything.
Good morning. 39 minutes until the equity market open this Wednesday morning here in Europe. Let's talk treasuries and figure out what is happening. You've also probably got to talk about JGBs as well. There is a firm focus on what is happening at the long end of the curve right now. You've got yields moving sharply higher. The US 30 years through 5% again. You've got Japanese 30 years firmly in focus. But the entire US curve, as you can see, is on offer this morning as yields move higher. Lindsay Rosner, head of multi-sector fixed income investing at Goldman Sachs Asset Management, has kindly joined us around the table this morning. Nice to see you.
Nice to see you as well.
There's a bunch of questions about US bonds, so let's just kind of start there.
Sure.
Are we going to 5% on a US 10-year? How high does the 30-year go? What do you think about kind of longer duration bonds right now?
So it's hard to pick an actual spot for where we kind of top out, but we think the direction of travel is obviously higher. We think that the curve is going to continue to steepen as it has. And it's not just a U.S. phenomenon. It's very clear in the U.S., but it is happening across the globe. And really what's at the core of it is just fiscal is in question. And it's not just a U.S. problem, it is a global problem.
Not a German problem, but pretty much everybody else. Front end. Fed going to cut? The mood music coming out of the Fed at the moment seems wait and see what happens. Wait until the data shows up, tells us what actually the tariff impact on inflation is going to be.
Yes, I believe in the presser waiting was used, waiting or some kind of version of that was used 20 times. So I think we've got the message loud and clear that the Fed is going to wait. I think what that really means is they're not going to be preemptive. But if we start to see unemployment tick up, they will move. And so our view is that there's probably 2 cuts this year. But it's going to continue into next year.
2 to 1 or 2 to 3? Kind of.
It's a good question. I would say on the margin, I'm probably leaning more 2 to 1 than 2 to 3.
Okay.
which is the direction we've been moving recently, isn't it? Taking out cuts rather than putting them in. Lindsay, so you're talking about, maybe not 5%, but the direction of travel for the 10-year yield is upwards. So you're moving up in quality, or you're talking about investors should move up in quality with that in mind. So where does that take you to? Where does that put the spotlight?
Sure. It's important for us to get the message out that you should continue to be invested. That when times are uncertain, I think there's just a natural proclivity to say, I don't want to be part of this anymore. But being invested wins out over time. So what are you supposed to do? You're supposed to move your portfolio more defensive, and that is, in fact, moving up more up in quality. For us, that means in structured product, rotating into the senior tranches, AAAs, for example, CMBS, CLOs, out of the triple Bs. And by the way, they've done well this year. It's not running away from something that hasn't performed. It has performed. It's given us a good opening to move up in quality. And then in terms of corporate credit, up in quality for us means triple Bs. So let's be clear, it's not double A's, it's not single A's in investment-grade corporates. But that triple B is really the sweet spot. And as we've just really gone through the earnings season, we've seen triple Bs are doing exactly what we want them to do. They're not spending cash frivolously. They're doing things that are very bondholder-friendly.
OK, so you're not too worried about credit markets broadly then. We heard from Jamie Dimon, and I'm sure, you guys have your own views, but we heard from him just last 24 hours saying he's a bit nervous about US credit markets. If you've seen enough of these cycles, you know what can happen with credit. You're not that nervous.
So it's more that credit to us is not monolithic, right? There's a lot of places that you can pick and a lot of things that you can do. There are parts of the credit market that absolutely concern us. We've eschewed triple Cs. We've felt that way all year. Also in 2024 when they did do very well. So we're staying away from those companies that we don't think are resilient. But there are things you can do bottom-up security selection that I think you're going to get rewarded for. And this isn't a baby with the bathwater situation. Some companies are not in, for example, the tariff crosshairs. Others are. So being very selective is really important.
There's a question when it comes to the Federal Reserve. I'm going to circle it right back to where Guy started this conversation. There's a question with the Federal Reserve. They need to be rethinking what the long-term average of inflation actually is. Does that mean that we should be rethinking what the normal level for a 10-year is?
Well, the math absolutely works that way. I think that's a great point, that the math on the 10-year is pretty simply GDP plus inflation. Whatever you think your trend growth is going to be plus inflation. So if you think that inflation is going to change, then naturally where you think that 10-year is going to go should also be altered. This 2% golden standard that we've kind of held on to forever, that I think does need to be rethought. The world's changed. And you have globalization on the one hand, but on the other hand, if there's any changes to globalization, i.e. tariffs and restriking the terms of global trade, that is going to impact inflation. And what was is unlikely to be what will be coming.
So in the last, I'm just looking at a chart here of the 10-year, going back to 2023, we've been in a range between 4 and 5% and haven't really skewed from that. It's more specifically 4 to 4.5%. Does it matter if we do ultimately get to 5% as the kind of hedging markets and the options markets are suggesting, if it's a slow and gradual move to 5%?
I think slow and gradual is really comfortable. I think if we're getting to 5%, there are different ways to get there, right? You can get there because you think inflation explodes, back to that math. Or you can think that growth is going to do better. I mean, the big thing that everyone was excited about at the end of last year into the beginning of this year that there's been a de-emphasis on is the release of animal spirits, right? There was a huge excitement in the U.S. in particular about deregulation, cut in taxes, pro-growth, and that just has disappeared. If that's going to enter the lexicon again and people are going to be discussing that, then actually you could have a higher 10-year on a positive note because of growth being more positive on the going forward. So that's what we're waiting for, to see what this fiscal pans out to actually be and what the whole equation means. We don't have all the information yet.
Lindsay, I'm going to put you on the spot 20 seconds here. Do you trade the developments in the SALT cap deduction?
So we have a really large muni franchise. I think that is going to be impactful there. But whether or not SALT is capped at 30 or 40 or less, I think that is very, very marginal because of the income caps that are placed or put in place.
Lindsay Rosner, head of multi-sector fixed income investing at Goldman Sachs Asset Management, walking us through the juicy bits of the credit market. We thank you so much. We're going to continue with the markets conversation. Rob Arnott, founder and chairman of Research Affiliates, joins the program next. Stick with us. This is Bloomberg.
Welcome back, everybody. 7:30 here in London. This is the opening trade, Wednesday, the 21st of May. Let's have a look at the futures picture for you. We've spent a lot of time talking about bond markets this morning. We make no apology for that because that's where there's a lot of interest, a lot of movement. Bond markets, oil markets, FX markets. Perhaps we've neglected the equity story. Here we are. The futures picture a little bit weaker. US futures, then, Guy, also suggesting we'll see some weakness. E-minis down by 0.5% right now.
I'll talk about the bond market. Believe me, I'm very happy to go back to the bond market. It remains the main story and the focus of attention. As you can see, you are seeing European bonds opening up. We have yields higher pretty much across the piece right now when it comes to the 10-year tenor. Obviously, the bigger focus over the last few days has been on the 30-year, and there again, once again, we see yields moving higher. Front end, you also see yields moving higher, so the curves are moving pretty much across the entire curve. There's some interesting things happening in bonds. There's also interesting things I would like to point out in the foreign exchange story, and I suspect Valerie has both in focus this morning.
Good morning, Guy. Yes, I wanted just to point out that on that hot CPI, we have seen cable hit a fresh 3-year high at 3.15 nearly for the pound. A fresh 3-year high. Hot CPI means we're more likely to get maybe a hawkish Bank of England off the back of that. We saw components rise across headline, core, and services for that CPI print earlier this hour. I also want to point out this just really chimes with the theme of this week that has been dollar weakness. The Bloomberg Dollar Spot Index down 1.25% nearly just in the last 3 sessions. Now, whether this is because that bill has maybe hit a snag in the House, or maybe this is pointing towards a long-term structural trend of frankly, just less dollar positioning. I did want to point out one chart that maybe just argues that this is a structural long-term rethink of the U.S. dollar outlook. This is the 1-year risk reversal, so quite a long-term option in terms of positioning for bearish or bullishness. You can see on this chart here, we've actually hit the most bearish positioning we've seen in the Bloomberg Dollar Spot Index, going all the way back to 2011. Maybe this chimes to the fact that this is a very, very much a structural rethink of long-term dollar holdings.
Valerie, thank you very much. Bloomberg's Valerie Teitel, and Valerie started there by talking about what's going on the pound. So just to recap, as she was speaking, I read headline saying that traders are paring their bets on Bank of England easing, favouring one more cut this year. So with that inflation print, certainly the services side coming in a little hotter than anticipated, the market dialing back how much easing they think that the Bank of England can do. Let us turn our attention to the global growth story. In times of lacklustre economic growth, governments often turn to stimulus to try to jumpstart their economies. But our next guest argues that aggressive government intervention actually slows real GDP growth. Rob Arnott is the founder and chairman of Research Affiliates, and please, he is armed with his research, joining us this morning on set here in London. Rob, very nice to have you with us.
To be here.
So you've done a lot of work on 40 years' worth of data, and when governments say they are going to do government spending, what does that do to global growth? And the traditional thinking might be that they can crowd in the private sector, that they can produce some growth. You argue that that's not the case, and you say the data supports that. Does it not depend what you spend the money on, though?
Oh, of course it depends on what you spend the money on. But you can spend the money wisely, sensibly, or idiotically. If you spend it wisely, then the impact on macroeconomic growth is likely to be neutral. If you spend it stupidly, it's likely to be negative. The simple fact is private sector has accountability, and if you're not doing something useful, you won't have a job. In the public sector, neither of those things is entirely true. Not to say that government spending is bad. Really low government spending, 10% of GDP, is the world of warlords and anarchy. But past a certain point, what you find is that historically, reliably, relentlessly, higher spending means slower growth.
And so you cite the RAN curve, and you've got lots of data that seems to support there is a sweet spot. Up to a point, it helps growth, after which it doesn't. But what about if the government spending is deliberately counter-cyclical, and actually it cushions what would have been a worse situation had the government not spent that money?
The evidence on that is pretty unequivocal that the long-term effect is negative. The short-term effect could conceivably be modestly positive. But don't count on it, and don't continue to overspend once the economy's recovered. Neo-Keynesianism differs from Keynesianism in that Keynes strongly believed that you run surpluses during the good times to be able to fund deficits during the bad times. He would be evicted from the court of Neo-Keynesianism if he were alive today. Neo-Keynesianism embraces the notion that you spend to create growth. Stimulus spending doesn't create growth. We found that cross-sectionally in every 5-year span, and more recent work, which we haven't published yet, goes back 60 years. Every single 5-year span, the countries that spent the most as a share of GDP had the slowest per capita GDP growth. And intertemporally within individual countries, the countries that ramped up spending saw their growth slow. The countries that ramped down spending, Ireland's a beautiful example of that, found their growth accelerating sharply.
The conversation right now, though, is addressing the deficit via massive spending cuts, whether it's federal contracts, whether it's layoffs, whether it's even things like chip grants, and et cetera. Walk us through the cracks that emerge in the economy when the government pulls back as aggressively as they are.
You know, there's a fascinating example of this buried in history. There were two Great Depressions in the first half of the 20th century. One is well known, the other is not well known. After World War I, there was a flood of soldiers coming back, looking for work, no work to be had, and we entered a severe recession in 1919 and 1920. This was inherited by Warren Harding, and Warren Harding is often described as the worst president in U.S. history. Why? Because he looked at a situation where tax revenues were down 25%. And so he said, oh, we got to cut spending 25%. So a flood of new workers, additional workers, came onto the market. Well, within 18 months, the private sector figured out good uses for these people, and the Roaring '20s started. So it was a severe but very brief depression. And the Great Depression saw the opposite government reaction, and it extended until World War II.
So is that what you're suggesting, that we're headed perhaps for that a repeat of the first outcome? You know,
if Doge were successful and resulted in sharp cuts in public sector employment, these people are going to get jobs. We all have had the experience of looking for a job. It can actually be fun. And the end result is you get a job. You're doing something useful, or you don't have the job for long.
Over what time frame? It's still a very tight labor market, as we can see by payrolls and jobless claims.
Absolutely. It's a tight labor market. The jobs can be found reasonably quickly. This is not a period of huge unemployment. So the point of the paper was not government bad, spending bad. The point of the paper was recognize that it's a trade-off. A wealthy economy can afford a robust safety net, can afford to take care of its disadvantaged, of its needy, but recognize that the more you spend, the slower the growth. So do you want your kids to be a little more prosperous than you or a lot more prosperous than you? If you want your kids to be a lot more prosperous than you, best to count on a lean government, and there's very few of them around now.
Give us the investment case around this.
Thank you for asking. The investment case is very interesting. Countries that reduce spending ultimately have booming economies and booming capital markets.
Where are we seeing that happening right now?
We aren't.
I thought that might be your answer.
Right now, we're addicted to the corridors of power are swarming with neo-Keynesians and MMT crowd.
Yep. Okay.
And when it comes to some of the chaos surrounding the Trump administration, I find it hilarious. Wall Street spends millions of dollars trying to model what tariffs will mean for unemployment, GDP, inflation, interest rates. Why do that? Firstly, the models for tying the link between tariffs and any of these macroeconomic variables are very weak. The models are lousy. George Box famously said, all models are wrong, some models are useful. these models aren't useful. Secondly, the tariffs change every day.
Okay, that's all true. What works in a 5% US 10-year world?
If the 10-year goes to 5%, it's, in the grand scheme of things, not a huge move.
Yep.
It feels like a huge move when it happens, but it's not a huge move, and the world will function.
What works
fine.
in that? But am I buying growth stocks in that environment? Am I buying, kind of, give me what am I? If that's the direction of travel, and you're talking about the fact that government spending is going to continue, which probably means that we're going to see higher yields going forward. What works in that kind of world?
If inflation rises, if interest rates rise, that creates an environment of increased macroeconomic uncertainty.
Sure.
There's no such thing as high inflation that's also stable. We had 30 years of inflation almost always between 1% and 3%. Imagine a world where it's almost always between 8% and 10%. It's unimaginable.
Yep.
If you have elevated inflation and elevated interest rates, you have elevated volatility of interest rates, elevated macroeconomic volatility, elevated broad capital markets volatility, and people seek a margin of safety. That margin of safety is found in value stocks. Value stocks are cheap. They provide more yield. They provide more earnings for every $100 you invest.
Sure.
And they're currently deeply out of favor and dirt cheap.
Somehow I thought we might end up at value stocks with you.
Really?
At some point at the end of the conversation. It all seems to end there.
Rob Arnott, founder and chairman of Research Affiliates, joining us around the table. We thank you so much for your time this morning. Coming up, we're going to shift focus to the retail sector right here in the UK. Marks & Spencer are taking a £300 million hit to its operating profit following a recent cyber attack. More details in your stocks to watch next. Stick with us. This is Bloomberg.
Let's call it 15 minutes until the opening trade here in Europe. Let's add a little bit of salt to the conversation. Kriti, over to you.
A perfect intro to what I'm about to talk about, which is kind of the bond market, but something that maybe isn't as tradable from a day-by-day basis or a tick-by-tick basis. And this is really important when it comes to the deficit because, of course, when we're paying attention to what Donald Trump is up to and we're getting this reprieve from the tariff talk, the conversation right now is very much in Congress. And really this idea where Donald Trump can get his tax extensions, the big, beautiful bill that he's touting across the finish line. This is one of the sticking points among a key of, or a sleuth of others is the SALT deduction. And for our international audience, it's worth reminding everyone that the SALT deduction basically for an American taxpayer is how much from the state and local taxes get deducted out of your federal income taxes. What this also means is the higher the SALT cap, the less federal taxes, federal tax revenue is collected. But here's where that problem lies for the bond market, especially in the backdrop of the sell-off we're seeing on the long end. The idea that it could actually exacerbate the deficit instead of bringing in some of those spending concerns that Donald Trump is trying to get through when it comes to some of the wasteful spending that he calls in Congress. That being said, that's where this chart really comes in handy because this is the projected revenue loss if we do get that SALT deduction. And right now, you can see going into 2028, even over for the next 3 years, it is a very, very high number. So, Anna, we're still coming around what those numbers actually look like for that SALT cap and what those revenue losses actually look like. But the direction is up in terms of the deficit ballooning.
Yeah, how much does this impact the fiscal outlook then for the United States? Over what time frame? All important questions for the market, no doubt. Let's move on and talk to Markets Live strategist Ven Ram, who joins us now with 3 minutes on the markets. And Ven, I say let's move on because I want to go back to one of our other stories this morning, which is around money going into havens, money going into oil as a result of other US media talking about what could happen between Israel and Iran. And the gold price has jumped on the back of that. It's traded as a haven. But you argue this morning that gold's outperformance, its days of outperformance are over. Give us the backstory.
Well, our backstory starts really from the third quarter of 2022, Anna. So since then, around then, gold was at $1,600 an ounce. Now it's $3,200 and doing something. So gold prices have nearly doubled in a span of 2.5 years. That is a compounded annual return of 28% using the rule of 72. So that is well above what other risk assets have yielded, the S&P, the NASDAQ even. So the Sharpe ratio is very high because gold has not only gone up, but it has gone down. The drawdowns in that rally have been very little. So which means that the Sharpe ratio, which adjusts for the risk, the volatility risk, is pretty high. And therefore, gold has had an exceptional run. Now, the question is, how long does this run continue? It can't be that an investment keeps returning 28% annual compounded. No one can replicate that performance. Even Warren Buffett would be happy with 15% compounded return. So 28% is way above everything else. So that puts it in perspective. Now, if you look at gold in the long run, what has it returned? It has returned inflation plus about 2%. So that is, in a world of about 2.5% inflation, that is about 4.5%. So at the moment, as we discussed, it's going at 28%. It's not sustainable. So there's going to be drawdowns. At the moment, as you mentioned, there's supportive environment for gold because of Israel threatening to attack Iran and all these geopolitical factors. So I think that, gold has some momentum going into this rally, and therefore I think that the rally can extend in the short term. So we are talking about levels of about 3,600, 3,700 even. But after that, I think investors should brace for drawdowns. And those drawdowns, when they come, they can be vicious. In 2012, gold plummeted like a stone, and gold has that property, intrinsic property, where it is overbought for extended periods, but it's also unloved for extended periods. So that may well repeat itself, which is why I think that, I'm not long-term bullish on gold.
Ven, I've got 30 seconds left. Everybody else is worried about deficit spending, government spending too much. That's not the case for Germany. Where does that safe haven story show up in Germany?
Well, it shows up in bonds and in 30-year bonds. If you look at 30-year bonds, they've done nothing at all this quarter, whereas yields have surged in JGBs, yields have surged in treasuries, and also 10-year bonds. And so, the ECB is going to cut rates. Inflation is already under control. And you get a 230 basis point pickup from hedging the currency risk on bonds. Therefore, what's not to like bonds?
OK, good. Thank you very much indeed. Great stuff. MLIV strategist Ven Ram joining us out of Dubai. MLIV is the function on your Bloomberg terminal if you want to get more from that fantastic team. Kriti.
Absolutely. Let's go from the macro to the micro. Got our stocks to watch now with Joe Easton. Joe.
Morning, Kriti. So watching Marks and Spencer's today as the company gives a trading update saying that the recent cyber attack could cost them around £300 million in profit. And actually the shutdown of the online business is costing them around £3 million a day. So really costly for this company. We can see the stock down around 10% over the past month as the news of that cyber attack did hit the stock. But over the longer term, we see it's one of the big success stories of the UK market over the past 3 years. We can see it up 170%, but we are seeing some calls lower on that stock this morning. Then in terms of chip makers, news from the US that a supplier called Wolfspeed is potentially going to file for bankruptcy. That hit that stock massively, as we can see from that drop there, down 60% in the post-market for Wolfspeed. And it's important for a few companies here. Ikestron, that one was a supplier to Wolfspeed, so potentially that could be impacted in terms of their revenue. And then ST Micro, a customer of Wolfspeed, as is Infineon. Also, there was actually some separate news on Infineon around a partnership with Nvidia coming out of the US. But potentially all these stocks are going to be impacted in a read across from this news in the Wall Street Journal around Wolfspeed filing for bankruptcy. So keep an eye on them. Then finally, the last sector I'm watching is oil. Given the big jump up we saw overnight in the crude price, it was up around 2%. When I came to my desk today, it's now up around 1.2%, so it's come down a little bit. But potentially this could be positive as a read through into the big oil companies. As we can see, big drops down in a lot of these companies over the past year. BP, the one we've spoken a lot about, Total Energy as well, down 20%. Potentially the higher oil price today going to be positive for the oil stocks. Keep an eye on them at the open of trading.
Joe, thank you. Our equities reporter, Joe Easton. And we've got that UK inflation report at the top of the hour, which could have an impact on some house builders, for example, if we're factoring in fewer rate cuts from the Bank of England. We'll keep that in in mind. Interesting, Bloomberg Economics, though, flagging what they call the core services inflation number and saying it didn't tick up quite as much as the sort of headline services inflation picture based on their analysis. So if you're looking for that kind of argument around why the BOE can still cut rates, then there it might be found.
Hugh Pill was warning yesterday about the impacts that quarterly rate cuts are going to have, and he felt that they were going too fast. I just wonder kind of what effect that's going to have on the rest of the committee and whether or not actually we do back off from the rate hike, sort of the rate cut path that we've been on. And kind of what effect that has longer term in terms of the rest of the economy. You feed that back into what the Chancellor's trying to do at the moment and the struggles that she's having. There's already stories, more stories about tax hikes rippling through the UK economy as well. Angela Rayner has been pushing those. There's all kinds of things going on here. And if inflation stays sticky, it messes with the entire kind of process that we're working our way through at the moment.
So this is a stickier inflation story, Kriti, that points perhaps to rates higher for longer. In the States, we have a different narrative, but it also points to rates being higher for longer. It seems that there, at least, they share some dynamics.
They do, but I mean, going back to the BOE, though, it's fascinating that they're still leaning into QT, and that's, I think, something no one is talking about to the same extent, because the BOJ and the BOE don't have a ton in common, I would say, except for this, except that they're both still leaning into QT at a time when we are worried about some of that momentum around disinflation falling.
The bank is sounding more dovish on that front.
Yeah.
The bank being the one over the road here.
Yeah.
And it's certainly sounding more dovish on that front. The inflation story in the States, though, the University of Michigan numbers are startling. And you do wonder if that's what's keeping the Fed on hold at the moment. They're just waiting to see whether or not that actually translates into reality.
Yeah, well, some of those expectations.
I was going to say there's a massive disconnect, though, right? In a way you're seeing kind of the inflation expectations, the front end of the curve, and then the deficit concerns as well. It's not all one page. So one has to snap, whether it's consumer sentiment or the bond market, or I guess it's going to be the deficit. That being said, all of that to factor into your day later today. Futures are pointing down. This is Bloomberg.
Is it only Wednesday? Feels like it should be at least Thursday or Friday. A lot has already happened this week. In terms of yesterday's session, probably a useful guide to maybe go where we're going into today. Europe went out here, a little bit of a sell-off into the US close, but then a little bit of a pop, taking us back to a fairly kind of flat position. That probably means you're going to see a slightly negative picture coming into the futures story this morning for Europe. But there's a lot of things going on here, and we're watching what is happening in Washington. We're watching what is happening with the inflation picture more broadly. There's a few earnings you need to fold in. Kriti, what does that tell us all about futures?
I think the takeaway from futures across the board is simply that risk sentiment is souring on both sides of the Atlantic, but on one side more than the other. And this is where I think this side of the kind of board is really important here. You're seeing a 0.6% drop in U.S. futures, not the same margin of a drop by Eurostoxx 50 futures. Anna, it's kind of muted. You look over at the FTSE 100, only down about 0.2% there as well.
OK, let's have a look at some individual stocks and sectors that could be in focus for us this morning. Of course, the energy space very much in focus. We have energy stocks there. This because oil prices are higher, not by as much as they were, but they did pop higher on other US media reporting about the potential for an Israeli attack on Iranian nuclear infrastructure. A lot of detail missing from what, our understanding there. But the market responded a little. We saw oil prices popping on that, so we'll watch energy names as a result. Chip stocks in focus as well. European semiconductors could be on the move today after the US firm Wolfspeed plummeted in extended trading following a Wall Street Journal report that the chip maker is preparing to file for bankruptcy. So keep an eye on German-listed Extron. That is a supplier to Wolfspeed. ST Micro, one of Wolfspeed's largest customers, could also be in focus. And we'll also watch Marks & Spencer's in the retail space, Guy, facing a £300 million hit in terms of that cyber attack.
You could also see effects from the pound into the FTSE. We'll watch that one as it starts to open. Here it is, the opening trade this Wednesday morning. Let's show you some numbers. FTSE 100 flat as we work our way through the initial seconds of the session. We are expecting a little bit of softness, maybe, though, to creep in. We'll see what the individual names look like. Marks & Spencer probably is a factor. The IBEX is down by 0.2%. The Stock 600 is down by less than 0.1%. This is not an exciting open thus far. We're looking for another catalyst maybe to come through. The DAX and the CAC are not open at this point, but you do see a FTSE that is weakening to the kind of anticipated level of down around 0.2%. There you go, CAC and the DAX in unison. French and German markets markets as one today, down by 0.4%. Let's call it 0.3%. Kriti, what are you seeing in the sectors?
I mean, broad declines here, and I think you're seeing it sector from sector. I mean, healthcare seems to be certainly on the back foot. Novo Nordisk is one of your biggest weights on this market this morning. But then you've got the likes of SAP, ASML also taking a little bit of a beating as well. So you are, of course, seeing the majority of the stocks lower, and even the ones that are in the green, they're not in the green by much. I'm seeing some of the banks having a fairly decent day. BNP, for example, UniCredit, we know BNP was ex-dividend, I think, yesterday as well, so a little bit of a recovery for that stock as well. But marginal gains, energy in the green a little bit, but that might just be a reflection of the oil story.
Yeah, exactly. That's one of the sectors that's not falling this morning. Food, beverage and tobacco is your best performing sector, which has a sort of defensive flavour to it, doesn't it? And so you see some of those brewery businesses going higher, but there are only 3 sectors in positive territory. Most are in negative. Autos and auto parts, travel and leisure, retail, those more volatile sectors, those are the ones on the downside this morning.
Absolutely. I don't think there's much actually to take away from this market this morning. There's a few individual names that are kind of worth focusing on. UK house builders are a little softer. I suspect that probably means that we are seeing an extension of the rate story into the equity markets. It's expected that maybe the Bank of England doesn't cut rates in the way that was originally anticipated, given the slightly warmer than anticipated inflation numbers this morning. So Barrett's a little softer. You've got Persimmon down a little bit as well. So some of those names are certainly coming under a little bit of pressure. But elsewhere, it's hard to discern a particular trend. You've currently got, in terms of the FTSE 100, I think 25 up and 72 down. So the breadth maybe sort of pointing slightly negative.
A few UK themes to focus on. The Gilt Open, worth a quick mention. Gilt's just started trading, of course, because it's just gone 8 o'clock. We had that UK CPI print, the 10-year yield rising a few basis points as a result of that. So we're pricing out some of those rate cuts. That's something that's weighing on house builders, as you were pointing out, Guy. And just as we were talking about UK matters, of course, Marks & Spencer is trading weaker on the back of that cyber attack impact. But we also have JD Sports, which stays in the retail space, smaller player, but in the retail space. That stock is down by 10%. The results surpassed expectations, but that didn't seem to be enough for the business this morning.
Essentially, the pound sort of initially went down on the data, which was slightly surprising. Then it went up a little bit. Now it's come back down again. So basically, there doesn't seem to be that much to see here when it comes to sterling in terms of the overall story. So you'd think that will be something you want to fold in. A stronger pound will be negative for the FTSE 100, but actually we're not. This data looks really tough at an initial read, but actually once you sort of break it down, doesn't look quite so bad. I think the market's sort of slowly digesting
That seems to be the argument coming out of Bloomberg Economics, at least, that there's services and then there's core services, and on core services they said, yes, it ticked up, you know, a substantial chunk, and more than expected, but it wasn't as big a jump as the headline services number indicated.
You know what's so fascinating, though, is we're talking about potential tax hikes coming down the pike. We're talking about sticky inflation. We're talking about really kind of price pressures across the board, and a BOE rate cuts that are getting priced into the back half of the year. We're still at 134 on cable when it comes to that against the dollar, which really speaks to the weakness that you're seeing in the States.
The biggest, the euro is amazing.
Yeah.
You got an ECB that is clearly kind of has been and maybe continues to be in cutting territory, and maybe cuts below neutral. I don't know where neutral is, but ultimately you've still got a weakening dollar. Yeah. The differential between what you're seeing in the States and what you're seeing in the Eurozone is extraordinary.
The dollar today is really fascinating. We'll get back to that shortly. For the moment, though, let's go back to the Qatar Economic Forum in Doha, where Bloomberg's Stephanie Flanders is discussing the global investor outlook with the managing director of the Kuwait Investment Authority and the co-chair of Oaktree Capital Management.
Extreme short-term volatility, lots of noise, but also some structural long-term forces, not least the trends that are pushing up the cost of money relative to the last few decades. I want to talk about how you're approaching investing with your distinctive portfolios and approaches, but I know there's also great appetite for getting to where that exactly is leading you on some of the practical opportunities you see, so I hope we're going to have time for both. But Sheikh Saud, you have quite recently become managing director of the oldest sovereign wealth fund, the KIA. Tell me something about how you think about portfolio construction in this environment.
Thank you very much, Stephanie, and it's great to be here today in Doha. And you said something about starting with noise. I would start off by saying, ignore the noise. If you're a long-term investor, ignore the noise. And how we look about global opportunities. We're going to talk about today about identifying opportunities based on mismanagement of risk. And as a long-term investor, you can't be lucky. In order to be successful, you just can't be lucky. Someone can be lucky in the short term, but over the long run, you can't afford to be lucky. And to successfully identify opportunities, you need 4 key things. You need to have a long-term strategy. You need to put a process around it. You need to surround yourself with the talent to pick the right opportunities. And you need to have the guts to make bold decisions when opportunities arise. And as a long-term investor going into portfolio construction, whether you're a sovereign wealth fund or a pension fund, you need to know where you're going, reverse engineer it, and you'll have a return of capital on average that you need to achieve. But that's where the main problem is, because investors sometimes tend to focus on chasing returns, but not looking at risk. So you have to assign a specific risk profile to your investment. And the perception is the more risk you take, the more likelihood of a greater return. But that can be deceiving. You can't avoid risk when investing. You need to understand it and know how to manage it. And risk can be deceiving because it's always an absolute number. It's always positive. But the more risk you take, the more the likelihood of a greater return. But the flip side is also true. The more risk you take, the more the likelihood of a lower return. And that's why you need to put a process around it. Because investing is rational, investors are not. And you need to eliminate emotions when investing, and we've seen that in the 6 months of this year. You've seen very volatile markets. You've seen animal spirits come at the beginning of the year, but they went into hibernation. And we've seen it change. And you'd think the world is upside down, but it probably isn't, and probably Howard has to say a few things about that.
Howard, Mark?
Well, this panel's kind of rigged because we agree so much. But, the essence of investing is appropriately bearing risk for profit. If there's no uncertainty, you're not going to get paid very much. As Sheikh Saud says, you want to have the right mix for your risk tolerance, but you also want to be aware in a long-term sense of where risk is being mispriced and thus where you can get superior risk-adjusted returns without actually taking too much risk. And, the last 15 years have been a very rosy period. Basically, I would say in the last 15 years, the person who took the most risk made the most money. But by definition, that can't be true all the time, or it wouldn't be risk. And yet, when people go through a very hospitable period and risk-taking is rewarded, it builds up. It's self-reinforcing. Just at the time when you should be reducing it, most people are putting on more. So I think risk consciousness and knowing what's right for you and your institution, not merely return maximization.
I think a lot of people would listen to this and say, that's all very well, but it's assuming you can distinguish these things. So Sheikh Saud talked about ignore the noise, but you don't want to ignore the signal, and you somehow have to tell the difference between the noise and the signal. You've talked about risk and uncertainty, but certainly as economist, I consider there's quite a big difference between the two. Risk is calculable, uncertainty is not calculable. It's just a sheer amount of volatility. So for those of us who haven't got an infallible way of telling the difference between these things, how are you confident that you're ignoring noise and not important signals?
I think you need to focus on hard data and not soft data. So I think if you turn off the TV, and I don't mean turn off Bloomberg, but and look at the hard data coming out of the US, the hard data has been coming in very strongly. But investors have been reacting as if it's the end of the world. So what happened in the past month, I think, is quite significant. You went from a bear market to a bull market in 4 weeks. And that's not normal. And that type of behavior meant people were because fear of missing out is real. That's the emotional part. So people have been buying into a rising market, then selling when things went south. And that means you bought high and you sold low, and you won't be in business investing, buying high and selling low. So, but in terms of signals, I would say it depends on the price that you're compensated on the uncertainty that's there. I think at the beginning of the year, we know there was a new president coming in. We knew about his policy about tariffs, so we knew about a known unknown, so we knew about tariffs. We didn't know what were the impact, so we knew about a known unknown, but we decided to do nothing about it. And I think that's when complacency came in, and some investors paid the price for it.
Howard, how do you distinguish these? I mean, when you say, you particularly emphasize the importance of understanding risk. But are there times when you say, okay, this isn't actually calculable, I don't know what the risk of this investment is?
Well, first of all, we never know the future. And that's where the risk comes in. There was a professor at the London Business School named Elroy Dimson who said, risk means more things can happen than will happen. And it is from the multiplicity of possibilities that the risk comes in. We have to acknowledge that. And, one of my heroes, John Kenneth Galbraith, said that there are two kinds of forecasters, the ones who don't know and the ones who don't know they don't know. And I think it's very important to know which school you're in. But it's our job to deal with uncertainty. We can't run from it. If risk avoidance ends up in return avoidance. We have to knowingly, intelligently take risk for profit. But the definition of the risk we should take is one that we're aware of, that we can analyze, that we can diversify, and that we're well paid to take. That's basically what I've been doing all my life. And when I started work in 1969, the banks invested in what were called the Nifty 50, and they thought they were investing risklessly in the best companies in America because of the quality of the companies. And if you held those stocks for 5 years until 74, you lost about 95% of your money. And so these people were taking risks they were unaware of, and that's the worst thing you can do. Keynes said that a speculator is someone who takes risks he's aware of, and an investor is someone who takes risks he's not aware of. We want to do it knowingly, not run from it, but and try to emphasize in the long run risks that are tolerable in quantum for us, and hopefully, as Sheikh Saud says, underpriced.
And something similar happened, I guess, for many people who are holding the developed country.
Bloomberg's Stephanie Flanders there in conversation at the Qatar Economic Forum, speaking to the managing director of the Kuwait Investment Authority, the co-chair of Oak Tree Capital Management. Howard Marks there making some comments around his experience of investing. Let's bring in another expert here in terms of how to navigate these markets. Steve Chiavarone, head of multi-asset group and a senior portfolio manager at Federated Hermes, joins us around the table. Steve, I love that he talked there about the Nifty 50 because those were the growth stocks of the 1900s, really, right? So you had the Walmarts, you had the Xeroxes, et cetera. People were investing in that era because growth was unbeatable, and growth has been unbeatable again in the last 10 years or so. What qualifies as a growth stock now?
That's a great question. Look, I think that difference between growth and value, Kriti, has been critical. It's explained, in our view, most of the difference in return between U.S. equities and non-U.S. equities. And I think one of the things that's maybe a little different now than it was at that period is how scarce growth is globally. Right? Remember, in the post-World War II period, you had abundant global growth. You had Europe was being rebuilt after World War II. That sparked growth. And I'm talking about growth in the widest sense. You had 2 billion people being brought out of agrarian poverty into urban middle class. There was growth that was abundant in the world, but you don't see it today. What you see in the world today is kind of aging demographics, higher debt levels, lower growth levels globally. And what has become unique, and it is a moment in time, I agree, it's not a permanent state, but what is a moment in time and unique is that if you want growth, if you want companies that are able to grow and innovate and develop new technologies. It really is a story about the United States and maybe secondarily China, but certainly primarily in the United States. And what you're seeing is an equity market that's responded to that, right? Tech in the United States is 3, 4, 5 times the size of the index than other developed markets. And so it's that scarcity right now that's driving those returns. Does that last forever? No. Do I think it's over now? No. I think that story still plays out.
Okay, so you're still, so if we see dips now, you're taking the opportunity to get further exposure to US tech?
That is the only thing that we did during the post Liberation Day sell-off, if you will. You've had these growth stocks really trade between 20 and 30 times over the last 5 or 6 years. You got to the very low end of that range. Even Mag 7 were at a 2-year low in terms of valuation. Again, unless you think there's a real big driving difference between their performance, that you're really undermining AI or growth is no longer scarce, we thought that was the best opportunity to add in a couple of years, and so far that's worked out.
Howard was talking about speculators and investors.
Yeah.
The story at the moment in the States is still buy the dip. Retail has piled back in. The instinct of the last few years has always been FOMO. If there's a dip, I buy it. I'm going to miss out if I don't because the market's going to rally back again. Is that still the right instinct to have at the moment, or does it need to be more nuanced? Because at the moment, it just seems to be this slightly sort of Pavlovian instinct once again that once the market goes down, regardless, you should buy it.
So I'm going to answer you recognizing that in order to sound smart, you're supposed to be bearish. And if you want to sound like a genius, you're supposed to be bearish with a British accent.
I
have neither. I have neither.
This is way too reductive.
What are you talking about?
I have neither. And so what I mean to say by that is the markets in the long term operate in long-term flat and long-term up. Long-term up, secular bull markets are built around demographics, and they're built around technology. And in the United States, you have a working age population that's going to grow 5 to 8% with the rise of the millennials and Gen Z, which is even larger after. And you have a technological revolution around AI and robotics. As long as you believe that you're in that secular bull, and we do, we think that that started in 2013, then you should, any dip should be recovered within 2 years or less.
Right.
That is the feature of those periods of time. And we believe that we're in those. Now, whether or not, this is the end of the tariff volatility, that's certainly an open question in a shorter run. Do we think that this was a dip to buy? Absolutely, and we did. And I think it's the right move because on the back of it, yes, there's the uncertainty around the tariffs. There's certainly a little bit of an economic slowdown that's occurred in the United States. But at the same time, we have pro-cyclical fiscal policy coming. We have deregulation coming. And we think we've hit peak uncertainty. You need to buy the market not when bad becomes good, but when bad becomes worse at a slightly less bad rate. And that's what we did.
I want to explore what a 5% US 10-year yield will do. We'll do that in just a moment. We're going to come back with Steve in just a moment. Steve Chiavarone, head of multi-asset group, the multi-asset group at Federated Hermes, is going to stay with us. If you want to follow what's happening out in Doha at the QEF, you can also do so. Live Go on your Bloomberg terminal is where you will find that. We'll be back in a moment. This is Bloomberg.
Welcome back to the opening trade. You are seeing the equity indexes a little bit weaker today, but not by a major margin, not a major sell-off that we're seeing across the board, but a little bit of a dampening in risk sentiment. Let's bring back our markets guest this morning. Steve Chiavarone, head of multi-asset group and senior portfolio manager at Federated Hermes, joins us around the table. Can we talk a little bit about these deficit concerns? Where it's freaking out the bond market a little bit. Is it doing anything to the equity market?
No. I mean, not at this point. And I think you've got to be thoughtful. It's a little bit more nuanced. If you look at what's going on in the United States relative to the deficit, very interestingly and surprisingly, because I didn't think this was going to be a priority of this administration, they're paying for large swaths of the tax cuts that they're putting through, right? I mean, the tariff revenue, if you assume 10% across the board, is roughly $400 billion a year, which multiply that by 10 is kind of paying for the extension of the Trump tax cuts with the additional $1.5 trillion in cuts. There were $1.5 trillion in tax cuts being paid for with $1.5 trillion of cuts. So it is an administration that's surprisingly trying to stimulate the private economy but not add meaningfully to that debt. It is ironic because, you know, we increased that debt by $8 trillion over the last 4 years, and no one really said anything about it.
Well, I mean, we did see some analysis very similar to the analysis you just sketched out from Bloomberg Economics yesterday that suggested, therefore, don't worry too much about what this does to the deficit, and yet still yields go higher, and the market. And the Treasury market worries. To Kriti's point, what stops that worry coming into the equity market?
So I'm a lot less worried about what I'm seeing in the bond market, even though yields are higher, than what I saw a month ago. Right? Because a month ago, when you saw that bond market selling off at first, you saw it selling off with equities moving down, the dollar moving materially weaker. And when you looked through, what you saw is that there were investors that were getting hit with margin calls and liquidating treasuries.
We're not in danger of seeing any of that now? I mean, the dollar is weaker again.
If this really is a U.S. issue, well, the dollar is weaker because of the debt ceiling. What's happening is because we're not able to issue debt, the Treasury is flooding the market with dollars as they pay down the general account. Once you get a deal here and you lift the debt ceiling and you start issuing debt, I think you're going to see the dollar strengthen again. If this was just a U.S. issue, then why is the Japanese 30-year bond doing what it's doing? Why are global yields rising the way that they are? If we have U.S. yields rising alongside the globe, and it's with an equity market that's stable, and it's with recession odds that are falling, that's a very different scenario than what we had a month ago when it was quite unorderly, or disorderly, rather.
But you think the dollar goes back up again? Because this is critical. If I'm a European investor or a British investor, trying to sound smart about what's going to happen in the States, the dollar's a real headwind for me right now. Like, if I'm a euro investor, the Nasdaq is still down by circa 10% year to date. That hurts, and the dollar is doing the damage.
So I've done a little tour of Europe over the course of the last week here, and my observations, just listening to folks, are, one, I think they're underallocated to the United States, and I think that there have been a series of trades that have taken hold in the first half of this year: defensive equities, non-U.S. equities, highest quality bonds, weaker dollar. I think you run the risk of getting suckered into those trades. I think that was a brief interlude in what is otherwise a very different story, and that is, it was an uncertainty trade. It was some quirks around the debt ceiling in the United States and what that did for the dollar. I think the second half is about cyclical, stronger dollar and U.S. outperformance. Again, there was a trade away from that.
With a tailwind of the dollar kind of helping me out if I'm an external investor.
You've got a Fed that's not cutting. You have a government that's going to stimulate, at least at some level fiscally. That's not consistent with a weaker dollar, particularly with tariffs. That's not consistent with a weaker dollar. I think that really is an artifact of what's going on with the way that the United States is financing itself right now. That comes to an end once the big, beautiful bill is passed.
30 seconds, really quickly. Are you seeing a material change in fund flows from Europe to the U.S.?
The way I would characterize it is, you know, if I'm a non-U.S. investor and I'm thinking about the appropriate weight in U.S. equities, I think that number should be somewhere between 30 and 50%, given that the U.S. is roughly 60% of the global market cap. In my conversation with institutional investors over the last couple of weeks, it looks like that number is closer to 20. I think that's under-allocated to a part of the world that's going to outperform.
Steve also points something else that's very useful as well. If you run a hotel, put an iron in it. It's a very civilized thing. Okay, Steve, nice to see you. Thanks for stopping by to see us. Steve Chiavarone, head of multi-asset group over at Federated Hermes. This is Bloomberg.
What I say is, I don't think that AI knows everything that's ever happened and how stock prices reacted to everything that happened. So they can emulate the path to success that worked in the past. That's a pretty good skill to have. I believe that AI can't sit down with 5 business plans and figure out which one's Amazon. I don't think they can sit down with 5 CEOs and figure out in advance which one is Steve Jobs. So there are limitations. But of course, most people can't do it either. So I think that just like indexation and passive investing has supplanted much of active management in the large cap stock world, I think that AI will supplant a lot of investing and a lot of investors, but hopefully not the best.
Okay, last question, and you've sort of raised it. Both of you have talked about the mistakes that people typically make, and good investment being about avoiding those mistakes. But I guess good investment is also about recognizing that you too will make those mistakes. So what have you got wrong in the last couple of years?
So I think what you said is absolutely right. And I think it's always about everyone would do something wrong. You can't avoid doing something wrong, but the important is when you do something wrong is to refine your process along the way. And in hindsight, everyone has 20/20 vision, but no one can predict the future. So you need to focus on your process. But I would say two key takeaways for a long-term investor is that it pays off to actively decide to be patient. And sometimes the best investment decisions you make are opportunities you don't pursue. I would put it that way.
But what have you got wrong?
What have we got wrong? See, we've been around for 72 years.
And you made no mistakes?
We always make mistakes, but we learn from them. And I think it goes about sometimes you need to keep refining your process, and sometimes you get carried away when things do get right, that you think you're getting them right, but you don't know if it's luck or skill. And I think as now the easy time of making money is over, you need to keep refining your process the whole time. I think that's what we've been focusing on. I mean, I'm privileged to have a great team working with me, and we've been focusing on process a lot. And I think that's the key thing. People tend to forget about process when things are going right, and they tend to panic when things are going wrong. If you keep your process there and have a playbook and a game plan, you should be ready when the opportunity comes. And I think, to be honest, as the KIA, we've always been ready when things went wrong. I think we've been great beneficiaries of the financial crisis. Maybe we've learned from our mistakes on .com, but in the financial crisis, the KIA played a big role in bailing out the financial services industry. And this man as well has made a lot of money in the GFC. Okay. So I think there's a few things we have in common.
We've not had a concrete example. Well, maybe 25 years ago in tech is the last time you made a mistake, is by the sounds of that. But Howard, very briefly, we're getting shouted at to leave. But what have you got wrong?
Well, look, we all have our biases. We can't escape them. The most important thing is to understand them and limit their effect. I am a conservative person, and I'm a skeptic with regard to new and not obviously meritorious developments. So that hasn't been a good thing in the last 15 years. That would have held you back in the last 15 years. So I've had to suppress that, and I can't always do it perfectly.
Okay.
I still think those are good values, but sometimes they get in the way.
Sheikh Saud, Howard Marks, thank you very much.
Thank you.
Stephanie Flanders in conversation there with the Managing Director of the KIA, the Kuwaiti Investment Authority, and of course Howard Marks, the co-chair of Oaktree Capital Management, having to suppress his kind of inner concerns about what is happening in these markets over the last few years. I want to take you to a different part of the building, out in Doha at the Qatar Economic Forum, where we find Francine Lacroix. Francine, over to you.
Guy, thanks so much. We're just outside the plenary, actually, so you can definitely see a bit of a buzz and conversations. I am delighted to be joined now by Amanda Staveley, the Chief Executive Officer of PCP Capital Partners. Amanda, thank you for joining us. Now, you've been coming to the region, you've been doing business in the region for a long time. How do you see Qatar right now? We know that they will also do some more LNG projects. That means money coming in. How will they deploy it?
Well, thank you, Francine. It's a pleasure to be with you this morning. But yeah, it's a really exciting time for Qatar, especially, I've been coming to this conference for many years. It's exceptional, and it was so exciting to be able to see, the new team at the QIA yesterday doing their first interviews. But I think, Qatar have been incredibly good, savvy investors for many years. So I think you'll just see more of the same. I know that the new CEO talked a little bit about private credit in this market. They've been leaders in that area from 6-7 years ago. Obviously, the new CEO understands the US market very, very well, so that will be helpful. And although it is a crowded space, I think you'll get some exceptional deals in that credit space. So I think it's an important time for the whole region because of the geopolitical thing. So it's important to remember that we need to focus on business sometimes, not just politics.
Amanda, overall, is the money raised in the region staying in the region, or will it be deployed internationally, given all the turmoil and turbulence also that we've seen on the market? Well,
I think it's a lot, a lot of it's going to have to stay in the region. It depends on which country you're in. Obviously, in Saudi, Qatar's gone through its build process. We've been here before the World Cup, and now it's extraordinary. There's extraordinary infrastructure. So their build program has pretty much completed. So they can now redeploy. We went to see some new projects with the Emir last night, which was extraordinary. So I think there's always going to be a combination of domestic agenda is key, but then Qatar's in a place that it can look towards other markets, whatever they may be. But with Saudi, you're seeing much more inward investment because they've got a World Cup program. And they've got a young population and a deep population, so they have to prioritise, the local markets.
How much appetite is there still for sports? You've also been instrumental, right, for a lot of sports ventures here. Do you see a growing appetite and in different sports, or still football?
No, I mean, we are now starting, we're just raising a new sports and media fund that invests across all sports asset classes. So we see continued support for sporting assets. Obviously, with Newcastle United, we're so proud of where they are, and we have the best partners in PIF and the Rubin family to take us through that journey. Amazing fans. But with the also continued success of PSG, especially this fantastic season, they've got an extraordinary
big
team.
Match.
Big match. I know you've got some passionate fans at home. Some might be on the French side.
On the other side.
And the other side. So I think there's going to be continued investment into sports, and it's becoming a much deeper asset class in terms of institutional equities. Always flown in for the past 5 years. You've got a combination of private equity investors, you've got those institutional investors and sovereign wealth funds, and then your high net worths. So you've got a lot of different capital asking for different things in sport, and I think we've got to see how that works. What we have to remember in sport is our viewer, and our young viewers, and young viewers today are increasingly. We've both got 10-year-old boy. Well, I think I've got a 10-year-old boy, and they absorb football very quickly, but their attention spans are not as long.
And so, how do you see that changing? Is it media rights? Is it actually teams are changing, and the way we consume, sports in general has definitely changed the last 5 years?
Yes, I think the media rights landscape will change dramatically, and I think we have to see a much more robust direct-to-consumer model built out over the next 5 to 6 years. The Premier League, which I love and know very, very well, has been, supported by some very solid media rights deals. Those will eventually, in the next 4 years, start to move away, and we have to be able to understand how do our young people, how do we grab their attention, and how do we monetize our assets.
Todd Bowley yesterday was saying actually players are being played too much, that there's a higher risk of injury. Do you see that changing anytime soon?
I think he's actually got a very, very important point. I mean, there's a lot of competitions. When we were just taken in from Newcastle, we moved into the Champions League, and we had to play the Champions League matches, the FA Cup matches, all of those others. Players get injured, and player health is very important. So I could understand how Todd feels. Newcastle had a season pretty much injury-free, but we had 2 years ago we had a disaster. So player welfare is really important, and we need to manage that.
Is there a big deal, another big sports deal on the Amanda horizon?
I hope so. We're looking at a very exciting. Well, we're looking at a number of deals in football, media. We're also looking at non-sport assets, private credit, and we're looking at a fund that just invests into other funds, fund of funds, and into their general partners. So we've been doing that, and taking a little bit of my eye off the sporting.
Valuations are good right now for possible, or again, because it's been a little bit bumpy, I don't know whether it takes a little bit longer for deals or funds to be raised.
Valuations, I think, have been quite toppy in sport. Depends on your assets. So I think we've been waiting, for valuations to come down a little bit so we can do them. But I think people know good capital is important, and I think it's often we get swayed by valuations. You can always do a deal in the right environment with the right partners, but obviously valuation is pretty critical.
Amanda, you're based in the UK, you're based in London, and I know you've spoken out about some of the things that the new government has put in place, maybe targeting non-doms. What are your peers telling you? Are they leaving London? We're hearing that people may actually move to the Middle East because of some of the things that Labour is putting in place.
Yeah, I mean, London, especially Mayfair, is quiet. It's very quiet, concerningly quiet. But, you know, I'm a huge Anglophile. I love the region. It's very easy for me to live in the region. I lived in Abu Dhabi for many years, so for me to go back is very easy. I choose to stay, still a UK taxpayer, but I'd like to see the government do more around, you know, attracting people back. It's not just the fact that a lot of non-doms have gone back, it's the fact that all the infrastructure around that has gone. So I think there needs to be a balance. I also think we need to make in the UK our competitive landscape as tax efficient as possible. So, you know, we pay high taxes, high corporation taxes. We need to be as competitive as possible with our European counterparts, else you will continue to see an exodus to the Middle East.
Are you having some of those conversations with the government? Are they listening?
Yeah, no, I think they are. I think government is understanding that there needs to be a change. Obviously, we're in a seismic political landscape at the moment. And I think that there's been so much focus on Gulf. You know, we had COVID, the fallout of COVID, and the issues. So I think we've sort of maybe taken our eye off the business landscape, the tax landscape, and that will you know, probably come back.
Amanda Staveley, thank you so much for joining us today. Real pleasure to speak to you in person here in Doha, Qatar, the Chief Executive Officer of PCP Capital Partners. With that, and I'm going to send it back to you in London. Of course, we'll have plenty more from the Qatar Economic Forum throughout the day.
Absolutely. Thank you very much. Bloomberg's Francine Lacroix, of course, on the ground at the Qatar Economic Forum in Doha. Coming up, plenty more from the QEF throughout the morning. We're live in Doha next. Jemana Basecha in conversation about the global macro environment. This is Bloomberg. Welcome back to the opening trade. 8:47, so 47 minutes into our European session. And the European equity market picture looks flat to negative, really. Down by 0.3% over on the CAC Chiavarone. Elsewhere, a little flatter. US futures pointing lower. Kriti, there is a little bit of risk off in these markets as a result of some geopolitical nervousness. Oil prices higher, gold prices higher. A little bit of a bid into some of those traditional havens, at least, on the back of some nervousness around the Middle East.
Absolutely, digesting some of the news flow there. But then, of course, it feels like a lot of the focus is what's happening over in the States and what that's going to do to the bond market, with ripple effects perhaps to the rest of the world. And that's just one of the macro themes we're keeping an eye on. Let's go back to Doha now, where Bloomberg's Jemana Basecha is moderating a panel quite literally right on topic, called Riding the Macro Wave, What's Coming Next. Let's tune in and listen for a little bit.
And so I want to kind of just say, like, what my view on what U.S. exceptionalism means, and then I'll talk about how we invest around that. So I think there are kind of 5 factors that have made the U.S. a really exceptional place post-World War II. The first is that we had very strong alliances. The second is very quickly an act from 1950 called the National Science Foundation Act, which, making it short, was just connecting research dollars from universities into the private sector that has given rise to a lot of the technologies that Rajiv just talked about. Third would be the exorbitant privilege of being the world's reserve currency. Fourth would be rule of law and constitution. And fifth would be demographics, that as a country, we in theory can tap into 7 billion people, whereas, you know, China, the world's second largest economy, has a smaller pool to come from. That's historically been true. I think we could argue we're taking all of those out for a little bit of a test drive right now. But ultimately, I think while some of those formidable advantages are bendable, they're probably not breakable. However, I think both things can be true. I think the U.S. can remain exceptional, and I think it's still possible that investors are going to look to allocate marginal dollars elsewhere. And I'm going to complete that thought. And if we get a second, I want to say something on AI. And what I mean by those marginal dollars is the following. Like, there's a lot of talk about whether we're losing or we're winning. I just want to posit to people that the United States of America has 5% of the world's population, 25% of its GDP, and over 70% of its market cap. So we came into 2025, one might argue, with actually a lot to lose. And I really dismissed the concept that people would allocate away from the U.S. In January. I just said, that's not possible. We are the world's reserve currency. We have all these formidable advantages. There's nowhere better to allocate capital. I actually still think that's true. And the middle market, which you talked about, is, if you add it together in the U.S., the third largest economy in the world. So, I mean, there are amazing opportunities. But what I'm hearing from investors all over the world is, yeah, America's great. And it may stay great. But maybe I don't need to put more than 70% of my capital into that equity market. The UK pension market currently has 12% of its assets in 7 companies that are American. So I just think a little bit of the disruption and chaos has made people look at the portfolios and say, maybe we would, benefit from some diversification. And I'll end by saying a place in this region that we actually are seeing a lot of interest is in emerging market debt as an example, which has actually outperformed, as has Europe, the U.S. in debt markets, surely, and in equity markets as well, in the case of Europe. But back to emerging market debt, half of that index is investment grade. So you have a lot of people, a lot of LPs looking at that and saying, do I want to be with the U.S. IG credit facing tariffs and slowing economy? Or might I be with an IG credit in emerging markets where I can get similar or higher spread? Look at this country, in Qatar. You have a good quality credit that's actually deleveraging. So I just think people are open to the benefits now of diversification. Yeah. And can I just say one thing on AI before? Do you mind if I wanted to make one comment on what you said? Because there was a chart up before about the Mag 7, and have so much more experience in technology investing than me. But one thing I wanted to say, when we look at the future of AI, and we've had a dedicated AI fund for 10 years, I completely agree with what you said. Currently, we have like 70% in the infrastructure, which, by the way, was money losing for the internet. So time will tell. Like, we think this is different. We should argue that. But we have 20% in the software and 10% in what I would call the adapters to it. And I think that's going to shift a lot. And we agree that the winners are going to be the companies that figure out how to adapt themselves. This is a very important point. It might be real estate. It could be industrials. It might be hospitals that could be the winners of that revolution.
Financial services. A lot of industries need to be disrupted. So agentic applications of AI over the next 5 years is where the fun will be.
Yeah.
The companies that apply generative AI.
I want to ask you about a sort of parallel theme, because data centers require a lot of power, a lot of energy. And what has happened in the last year or so, the last 6 months, is the hype around energy transition, around ESG, has fizzled out. But when I speak to people, especially in this part of the world, when they talk about investing in data centers, they tell me a lot of that is actually going to be powered by renewable energies, by potentially nuclear energy. Is that going to give the energy transition basket another push?
Absolutely. And the push for green was good. We will need a lot of energy for many reasons. Data centers, we have 8 billion people on this planet, and of which 3 billion are becoming affluent in India, Southeast Asia, China, and in Africa, whose per capita consumption of energy is going to go up as they become affluent.
We are, of course, listening live to conversations coming out of Doha. Bloomberg's Yamana Bersetchi there speaking to Katie Koch from TCW Group and One Investment Management's Rajiv Misra. Terminal subscribers can continue to watch that discussion. All the events there from the Qatar Economic Forum. LIVE Go is the function on your terminal.
Let's talk about these markets. Katie's on fire. She's on great form, as ever, talking about America being exceptional, but are people going to allocate in the same way that they normally or have done over the last kind of 10, 15 years? Morgan Stanley says Buy America is still the trade. except for the dollar. Strategists have raised their call on US stocks and, interestingly, treasuries, but still see the dollar continuing to weaken, which kind of maybe throws up different opportunities for external investors as opposed to US investors, which is an interesting kind of way of maybe looking at this. Verily Totel joining us around the table. The dollar. The dollar is weaker this morning. Once again, and it seems to have been the exception to the exception recently. America has been exceptional, but the dollar has been an exception to that.
Yeah, exactly. You know, I guess you're hearing on that panel there about American exceptionalism. I think the question now is, fine, maybe the American equity market can outperform, but does that still mean you want to be exposed in FX terms to the U.S. dollar? And, you know, if we look at the options market, this is this chart on screen. This is one-year risk reversals on the Bloomberg dollar spot index. So this is a long-term dollar sentiment kind of indicator. And look, that is showing a extreme bearish positioning, most bearish that we've seen on record going all the way back to 2011. So around 15 years of data on this. And I think this just shows that, fine, the equity market can bounce, but that structural thought around dollar weakness might be there, might be pervasive for some time.
OK, so not a lot of appetite for dollars. Also not a lot of appetite for the long end of curves. I was going to say JGBs, but other curves also might apply, might fit in that bucket.
Yeah, no, that's right, Anna. It seems to have gone global, yet we have this issue in Japan with the Bank of Japan paring back its asset purchases, yet those Japanese lifers have really not stepped in a meaningful way to be that, you know, fill in that gap. And then we have to talk about what's going on here in Europe. We had a recent vote of the Dutch pension reform that failed. This is just another sign that perhaps these Dutch pensions funds will have less of a reason to hedge. And we know that they're massive whales in the long end of European swap markets. A lot of the reason why the long end in Europe was pinned was because of this hedging flow, and that continues to be less and less. That's just another factor to drive up global long-term yields.
Okay. A number of different factors working against long-end yields. It does seem as if the Treasury market is definitely the whale in that story. Like, different sizes of whales. They're all pretty big. Valerie, thank you very much indeed. Plenty more still to come from the Economic Forum out in Qatar. I have to say, listening to Katie, she's always good to listen to. We've got some great other guests lined up throughout the day.
Yeah, absolutely we do. We have, tune in tomorrow, very specifically for Jamie Dimon, our exclusive conversation there. The JP Morgan CEO joins Bloomberg on the first day of the Bank's Global China Summit in Shanghai. I've jumped ahead, haven't I? That's not QEF. That's another event, but that is still definitely worth tuning in for. In the meantime, we will have QEF for you, Qatar Economic Forum, and there'll be plenty more conversations. Live Go or here on Bloomberg TV will bring you the highlights. All of that. European equity markets kind of treading water this morning. The Pulse is up next. This is Bloomberg.